So welcome. My name is Megan Mountain. I am the Director of Partnerships at Wealth Factory. We have an excellent webinar with you guys today, and we're so excited to have you here. So thank you so much for joining us. Today, we will be diving into active versus passive income and navigating material participation rules with none other than Heidi Henderson, the Executive Vice President at Engineered Tax Services. Heidi, thank you so much for joining us today.
Hi, thanks, Megan. I always love being part of this group. Wealth Factory is amazing. And I see quite a few people on the participants list that I recognize. One I just had a conversation with this morning. So the timing is always perfect on this type of education. So I'm looking forward to digging in. This topic today, it's a little bit different from a specific incentive discussion. I've done a couple of others. We've done cost segregation, which you can watch before or after this, but either way, I would suggest watching that as well, because it really does tie into how all of this sort of benefits. And I'll talk about cost segregation just very briefly in this presentation, but we're going to dig into some interesting topics and questions that I deal with on almost a daily basis with investors that are really trying to understand better about how to invest in real estate and understanding some of the tax implications, like how to structure things from that tax perspective. A little bit about myself. I joke around, I'm a reformed accountant. I started in accounting. I have a master's degree in tax, but quickly found that I needed or wanted something a little bit more dynamic. I wanted to feel like I was having much more collaboration and discussion with individuals, and I think the conversation, and I'm a problem solver, so I've always loved finding problems and trying to fix them, and that's essentially what we do at Engineered Tax Services. I am one of the partners here. We have a few different companies, actually: Engineered Insurance Services, Engineered Tax Services. And then we have a couple others that actually consult with CPA firms as well. So we do that to help provide continuing education. As you may know, if you have a CPA, sometimes if you have a CPA that's not familiar with real estate structuring or real estate investing, if they're not familiar with certain tax strategies like cost segregation, they can become a little bit of a struggle, because you might educate yourself on these topics. And then you go to your CPA and say, can you help me with this? Or should I do this? And they say, well, I don't really know anything about it. I can't help you with that. Or sometimes they'll have other comments that you just really don't align with what you're finding in your research. And so we try to teach the accounting industry as well. And so we really serve as a specialist that comes in and can have an interplay relationship between you and your tax accountant. So we don't do tax returns. I like to always preface that. But we can work with your CPA, provide all the tax code data, get really technical, and help them understand how to make the changes on your tax return after we've finished doing an actual physical study or an analysis to capture some of the tax benefits. So that's kind of how we play. Again, like the medical space, we're a specialist. Like your orthopedic surgeon, we kind of do the surgery, and then you go back to your family practice doctor, your CPA, for them to do the tax return. And so that's kind of how we're structured and what we specialize in. Today, we're going to talk about the basics of depreciation and how depreciation essentially is going to carry down onto a tax return, and to determine if something's passive versus active. And this is a lot of tax terminology, but if you own real estate, or if you are looking to own or have a goal of becoming a real estate investor, understanding this stuff is so fundamentally important, because it can have a tremendous impact on how your investments work for you. And then also if that's actually helping you save tax dollars. And thereby, if you're saving tax dollars, typically we're able to take that savings and roll that back into future investments so that we can grow. That portfolio is growing. You're buying more properties. You're taking that and scaling that up and up and up. And we've had many of our clients that have done that systematically over the years. And it's incredible to see some of our clients who bought their very first rental property And now 10, 11, 12, 13 years later, they've got 25. I literally have a client with 2,500 units under management. And it's remarkable. So it is possible, whether you want to have 5 or you want to have 2,500. It's really interesting how the tax code is meant to help support you in those activities, and they incentivize specifically real estate investing as well as improvements. So with that, we're going to start at the basics. One of the questions I get all the time, or confusions, is what exactly is depreciation? And the sad thing is we talk about it all the time, like in the tax world. Your accountant probably tells you that, your bookkeeper might tell you that, you might have heard about it. But in actuality, there's a lot of people that really don't understand what is depreciation and how does it actually function on my tax return. So we're going to start at the basics. Depreciation, it's depreciation of a fixed asset, which refers to the gradual reduction in its value over time due to factors like usage, wear and tear, aging, and obsolescence. So the process is systematically recorded in your financial statements to reflect the asset's decreasing worth over its useful life. Super interesting, because when we buy real estate, we invest in that because of its future appreciation. We anticipate that that asset, this property that we buy, is going to increase in value over time. So then you think, well, why does the IRS allow us to claim depreciation and essentially write down the value of the property on our books over time when the actual value of the property usually is increasing? And the reason that they do that is because the assets of a property, we'll use a rental property as kind of my example throughout this presentation. For rental properties, if you don't do anything to the asset, you literally make no improvements, you make no changes, you just own it, you rent it out, you let tenants do whatever they do, you make no changes, the property is going to decline over time and the assets will continue to wear down. For depreciating assets on buildings, residential rentals, long-term residential rentals, are depreciated over 27.5 years. A commercial property is depreciated over 39 years. So this is the quote unquote useful life of real estate for residential or for commercial properties. The IRS has determined that if you own a property, again, we'll call it a residential rental, and you do nothing to that, the roof is going to fail, it's probably going to start leaking, then it's going to run down the walls, then it'll get moldy, then the carpets are going to be destroyed and the appliances will fail, things will start to break, things will start to break down. And at the end of 27.5 years, if you don't replace any of those items, the home is probably worth very little, or is in what they call the condition of disrepair. So essentially it's lacking repairs to the point that it's beyond repair. That's why we take depreciation. However, when we buy a real estate asset, we also know that there's typically other assets that are included outside of the structure. It's not just the walls, the windows, the roof. We're looking at personal property that was also acquired within that building. And those items can fall within these categories of 3, 5, or 7 year buckets or 15-year buckets. 3, 5, or 7, this is personal property. So inside a rental property would be furnishings, carpeting, window coverings, appliances, some of the cabinetry, depending on install, certain light fixtures, decorative type woodwork, really anything that's considered a fixture or furnishing. 15-year property is anything that's outside. So exterior fencing, landscaping, sprinkler systems, bushes, curbs and gutters, anything that's outside is going to drop into the 15-year category. So the IRS says, look, they've defined this. They are saying, we know that these assets we're going to assume will last 5-year carpeting for 5 years. And after that point, you need to essentially replace it because it really has no further useful life. And so this is kind of how the IRS has defined depreciation and how we kind of write down these assets over time. Now, typically we're doing improvements, right? So when we do own it, we are spending more money. We're doing improvements to add and better the property. So then we're adding to the value. So let's say you buy a rental property for $300,000, and in year 5, you have to put a new roof on for $50,000. The $50,000 new asset, it gets added to your $300,000 cost, and now your cost is $350,000, and you start to depreciate that. So that's why, as you're making improvements to the property, it keeps adding to that basis. And that's how it kind of keeps the value higher, even as you're depreciating the original things you purchased. So just kind of defining depreciation. Now, going back a little bit and looking at historically how we've dealt with real estate. I apologize. I usually don't use slides with a whole bunch of text, but I wanted to share a couple of articles. This one talks about how highly paid professionals historically would buy a rental property, they would depreciate the property, and then they would take the losses against their high income. Then in 1986, they passed a code section, IRS Code Section 469, which is the passive activity rules. And in 1986, what they did, we'll bump down to this one. The rules said these rules made all rental properties passive by default. So at that point, there was no way to make rental properties non-passive. So what passive means, and I have one more slide, and then I'll show you visually what passive means from an activity standpoint. But what was happening is all of these highly paid individuals figured out, my gosh, I can use this as a tax shelter. I'm going to buy real estate. It's this huge tax shelter, and I can use it so I don't have to pay any taxes. And the IRS was recognizing that it had become a bit abusive. And so that's why they changed the rules. 1986, you know what? All real estate activity is now considered passive, which means you cannot apply any of your real estate losses or depreciation against your W-2 income. W-2 income is active. And so now the rental property is considered passive. You cannot apply one against the other. So again, this is 1986. So then through additional rounds of lobbying, a new law was passed in the mid-1990s, which was called the Real Estate Professional Status Rule. Real estate property trades or business owners were then allowed to use the losses from their rental properties and then classify those as non-passive. So they could actually use some of the losses from their rental property and apply that as non-passive, meaning active, and it would apply to their primary income, their W-2 income. And the rules at this point in the rep status, in order to qualify for that, you had to work at least 750 hours per year or more than your total working time. And that had to be in real property trades or businesses. So in order to qualify under this real estate professional status, that was kind of the designation. You have to have at least 750 hours a year, or it has to be more than 50% of more than half or more than 50% of your time really focused in real estate. That was the only way to be considered for reps status, and reps would then make it active. So there's some huge benefits. Now, don't confuse the real estate professional status with being licensed, because that's one interesting thing is sometimes we're talking tax, right? But in the real world, being a real estate professional, we might correlate that to going out and getting your real estate license, which you could certainly do. But for tax purposes, there's no licensure that is required. There's no certification. There's nothing you have to do per se to file for and claim this. It's just that you have to be able to prove, that when you claim this status on your tax return, you have to prove to the IRS that you in fact spend the majority of your time doing real estate related activities or working in real estate related businesses. Therefore, you qualify. And if you do, then what happens is the depreciation we see by utilizing things like cost segregation, where we're accelerating depreciation, we have these huge numbers for depreciation, much, much higher than just a standard number. Then we're able to use this and again, apply it against all of our ordinary income. And for most real estate investors, that's kind of their goal. Even if they're a professional, high income W-2 earner, their goal is really looking at how they can convert that activity for real estate against all of the income on their tax return. So we're going to talk about how that can be achieved with the REPS status, but also then talking about the short-term rental loophole, which is really, incredibly significant right now. But this chart is actually an older sample of depreciation with cost segregation and the amounts. I mean, this is a $5 million building. The depreciable basis was 4.6 million, but you can see the depreciation increase is pretty dramatic at having, $300,000, $400,000, $500,000 of write-offs every year that are, if you can claim REPS status, then that's going to offset really all of your income. So depending on how much you're paying in income tax, you could generate a pretty dramatic tax refund, or reduce what you're paying in taxes and be able to use that money to then reinvest that into other properties, which again is typically the goal for most investors. I want to give you an example of how this calculates out. So I was explaining depreciation, why we claim depreciation. We're essentially writing off the value of an asset as it's deteriorating over the allowable timeline that the IRS has defined. But then defining what depreciation is always important because sometimes there's confusion here as well. Depreciation is reducing your taxable income. So the cash value ultimately depends on how much income you have, how much you pay in tax, and what percentage of tax you pay. And so when we're looking at doing cost segregation, we're looking at the depreciation benefit. We need to look at that to calculate out how much am I paying in taxes, so I understand what's the actual cash value. What may I get in a refund or just simply I don't have to pay when I file my taxes. So giving you a comparison with no depreciation in this taxpayer's situation, let's say they make $200,000 a year, and then they've got just general expenses, $75,000 for whatever standard deductions. Maybe they have a work vehicle and a home office and whatever. So whatever expenses they're able to deduct, that leaves their net income, or on the tax return adjusted gross income, at $125,000. Therefore, this is what they're going to be taxed on. So this is income, 125. At that amount of income, their tax rate's 24%. They're going to owe $30,000 in taxes. When we take depreciation, we have the same top numbers. We've got our income less expenses, which gives us this net 125,000. But in this case, we're depreciating a property. So we've got some real estate. Let's say we have $50,000 of depreciation. This is reducing your taxable income. So now the income after depreciation is $75,000. So not only are we reducing what's being taxed, this also has dropped this taxpayer down to a lower tax bracket. So now they're paying 22% tax on this, and they're only being taxed at $75,000 instead of $125,000. And so their total tax is $16,500. They saved $13,500. So $50,000 of depreciation has resulted in about $13,000 of cash, or ultimately they're not paying an income tax, or they will get a refund if they were paying through their payroll. So hopefully that kind of helps you understand how we fundamentally calculate depreciation. And when you're looking at this for your own properties, how that's going to apply in your own personal scenario. Now we're going to talk about active participation in two scenarios: REPC, the real estate professional status, and we'll also talk about the short-term rental loophole. First one is passive activity is defined as, first off, you have no material participation. So typically we're going to see this for a long-term property. Maybe you own one rental property. You've set it out there. I have one rental property that is long-term rental. I've got a 1-year lease on it, and I pretty much have to do nothing. Like, they Venmo me rent and it's in my account and I don't have to really worry about a thing. So I have very, very little material participation. So that's very likely passive activity. Material means that you've got to have involvement on a regular, continuous, and a substantial basis. And you have to have more than 10% ownership. So if you invest in a syndicated fund, or you invest with another group that you are an investor in real estate and you have less than 10% ownership, you would absolutely be passive. Passive activity is not deductible against non-passive income. So your W-2 wages. So we draw a line in the sand. I'll show you a chart on the next page. Active participation does allow up to $25,000 deduction if your income is less than $150,000. So this is actually, if you are still passive, you can claim some of the deductions if you have income less than 150. So there is some benefit. It's not all lost. And any unused losses carry forward, and you'll be able to use them when your property is sold. You'll be able to apply that depreciation against any of your rental income. So at least any income from your real estate is still offset by the depreciation. It's just not going to offset the W-2 income. And so there's the difference on those two things. Looking at this chart, I have this line here because when we're looking at a passive situation with passive real estate, everything on that side of that line are rental income because you're not a real estate professional. You have other investments. So you could have a brokerage account in your 401k and whatever other investments that you might have. They're over here on this passive side. Your expenses are your depreciation, your operating costs, any wages, any costs for actually operating this business, this investment, whatever's on this side. Those things will offset themselves. This depreciation will offset this income and will offset other investments. But this stuff over here, if passive, does not link over and apply to any of these active activities. And active is W-2 income or wages, or properties that do qualify as you as active or a real estate professional. And then those things that are on the active side are your primary mortgage interest, your other deductible expenses, your charitable contributions, earned income credits, any of those things on that side. So they all offset each other on that side. And then on the passive side, they stay over on that. They offset each other, but they don't come across that big line because the IRS says, no, we're going to keep that over here and still make you pay your tax on that active income from your W-2 job. So the opportunity then arises to then explore what it would take to achieve the real estate professional designation, because the tax benefits can be pretty dramatic. I have a couple of examples that I'll show you. But active participation, as I'd mentioned before, more than half of your personal services or half of your time that you spend for work or whatever you do to generate income, more than half of it has to be attributed to real estate related activities or real estate businesses. You have to have more than 750 hours per year in real estate related activities. Material participations, you're actively participated, actively working on things as it relates to the home, to improvements, to buying or selling properties, renting, managing, maintaining, improving, any of those things. But material participation as it relates to that. And then you must keep a time log to really track the hours that you're spending, the time that has been applied to those activities, and make sure that you're properly documenting that so that when you claim that designation on your tax return, if you get audited, you're able to come back and say, yes, here was my time. Here's essentially what I was contributing or working on in the real estate activity or real estate space. Now looking at active participation, this is what's interesting is one of the strategies that we see often is a spouse who has a W-2 income and then the other spouse who has the real estate professional designation. And this is a strategy we see a lot. We have this conversation probably every single day, as couples who are married filing jointly are looking at how one maybe has a very high income, maybe the other person becomes that real estate professional, or they are in real estate. Maybe they're a real estate agent, or they're managing a short-term rental and they're handling the properties on that side. Then what happens is you have the spouse's income, you have their W-2 income, you can see their typical expenses, normal deductions. They're at a tax rate of 37.5%. and an income tax of $51,000 with no depreciation. Then it kind of shows you their tax rate after depreciation. Then you have spouse two, who does have a real estate professional status. They're able to claim the deductions, the $60,000 of depreciation in this case, which then reduces what they're being taxed. And the cash difference between being able to roll all of that together for them with $60,000 of depreciation is generating about $25,000 in tax savings, essentially what they're getting back, because they're not having to pay the tax on that higher amount. They're paying the tax on the lower amount after the depreciation is applied, because it all rolls together in a combined return. If one person is a real estate professional and the other person is not, if it's active for one, it's active for both. And that's a huge opportunity as it relates to real estate. Now the kicker. The kicker is the short-term rental loophole. And this is a dramatic change. And this, I don't know if y'all have mentioned, I wish I could see everybody. It'd be like, show of hands. How many people have noticed that everybody owns a short-term rental property? And there are short-term rentals everywhere. This is very likely why. I mean, obviously, rents and nightly stays generate significantly more income than a long-term rental does in most places. But the short-term rental loophole has benefits to it that are really quite dramatic. The short-term rental loophole has saved people thousands of dollars because it does not require you to be a real estate professional. This is actually found in code sections. If your CPA is not familiar, you can use this as a resource, but it's in IRS section 469, and it defines the exceptions to the definition of rental activity. So the short-term rental loophole is an exception that they put into that real estate professional ruling. And this is what it says. First off, we know in 1986, they said all rental activity is now passive. Then in the 1990s, they added the real estate professional status. Then a couple of years ago, they changed it and they said, you know what? We're now going to make an adjustment and add this short-term rental option. And what it says is that if your property averages rentals of 7 days or less over the entire year, so essentially you look at all of your rental stays and the average of stays is less than 7 days overall, that you offer significant personal services. So significant personal services is you're leasing it, you have some goodies inside, you're cleaning it in between all of the guests. You're offering any other concierge services that might be available for that visitor tenant. You're doing laundry services, whatever that may be for the property, which is typical with a short-term rental. And then in addition to these, one of the following. Either you have 500 hours annually. 2, you do substantially everything. So you don't necessarily have to clean it, but you do substantially everything. So more than anyone else that does on that particular property. The other option is more than 100 hours and more than anyone else. So this is really the way. I probably should put a giant yellow highlight over this one. 100 hours a year and more than anyone else. Your business participation for 5 of the past 10 years, or regular continuous provable participation. One of the following. Typically it's this one. It's more than 100 hours per year and more than anyone else. And so you are actively managing it. You are offering services. You're dealing with Airbnb listings. You're scheduling cleanings. You're texting guests, all the things to provide service. Essentially would consider the property becomes a short-term rental, and then it becomes active. The reason being Well, I'll kind of pull up this slide. Why? Why is it considered a loophole? It's in the tax code. It's in the regulations. There's several court cases that upheld it. The reason that it's considered a loophole is because at the time the code was written, it was intended for hotels and motels. So for people who are running a business, the writers of these regulations, they didn't foresee this whole Airbnb VRBO movement. This whole thing came out of nowhere. And then all of a sudden, well, the definitions of short-term rentals essentially are the same as hotels and motels. We're doing short nightly stays, we're cleaning, we're doing laundry, we're doing the same activities. So this has created a vast marketplace for short-term rentals that could be managed remotely, booked easily by the users from their smartphones, and yet it's actively managed by the property owner. And so that's why it's considered a loophole. When it was written, there wasn't really thought for short-term rentals. But then, of course, the world changes, and here we are in the Airbnb world that we live in. And so, again, this is why we see a massive onslaught of short-term rentals and investors buying these kind of properties. Now, a couple of mistakes or pitfalls to watch out for when looking at short-term rentals and ultimately identifying, how this applies, when it applies. One, misclassifying your property as a short-term rental. So you have to ensure you have 7 days, or your average stay is 7 days or less for the year, and ensure that your rental provides substantial services. So again, substantial services, you're cleaning, you're laundering, you're, offering a guest book and concierge services if that's requested, but typical hotel stay options. So you're communicating with clients and offering services. So that's mistake number one, is missing really that 7 day average. So beware of that. The second one is misunderstanding the less than 7 day rule. So some investors think that they can achieve this by having one tenant sign multiple short leases. Sometimes we see this with taxes and people will find a workaround. We would suggest not finding a workaround, that it really needs to be 7 days or less. So you track each tenant's use period accurately, avoid manipulating leases to fit the rule, and really aim for genuine short-term stays. You may have some people that are there for longer, but the goal is that on average, it's 7 days or less. So beware of that pitfall. The next one is ignoring personal use days. This is an important one because I have a lot of people that buy properties that they intend to use as a vacation property, and then when they're not there, they'll just Airbnb it. However, the IRS says that if you use that for more than 14 days or more than 10% of the total rental days, it's considered a personal residence, and you can't claim any tax losses. You can't claim any depreciation. So you have to be aware of that. The good news is that if you're staying at the property because you're doing repairs to maintenance, you're doing work on the property, you're actually there for a purpose, it's not considered personal use. So there is a little bit of a gray area there, but keep meticulous records on how often you're there, refrain from using your short-term rental for personal purposes, and then make very strategic use of your repair and maintenance days. So again, with the IRS, everything is about tracking and documenting what you do, why you do it, what days are, and keeping track of that stuff. Common mistake number 4, failing to track contractor hours, because that's one thing. You have to have more time than anyone else. So if you have a contractor who is working on the property and they work more hours than you, that could actually impact your ability to use this 100-hour rule. So make sure you keep detailed logs of the hours of any contractors, of any cleaners, property management, anything that you can use to track the hours and track time, because that is one pitfall on the 100-hour rule, is you have to have 100 hours and more than anyone else. So be aware of that if you're hiring a contractor. Common mistake number 5, overlooking local regulations. So understand that many of our local cities and states, counties, are actually putting very strict regulations on short-term rentals. So research the regulations before you buy or invest in something. stay updated on any changes in local laws, maybe get involved in those discussions if they're having town hall meetings or they're having debates. I've had to attend a few of those because the communities can get very, very strong about banning short-term rentals. I'm based in Las Vegas, and Las Vegas is an area, the casinos are not a fan of having competition. So short-term rentals are not, they are not well received in this market. So it's very important to understand the market, really important to understand how those rules can impact you as an investor and how you may or may not be able to utilize your property in a short-term sense. Now, understanding that, I was explaining the cost segregation and how accelerating depreciation. Again, I did a webinar on cost seg, so we'll breeze over this very high level. But understanding the details here, this is essentially when we're able to accelerate certain portions. We pull things in this scenario. This is everything is in 27.5-year asset bucket, but the cost segregation is creating an inventory list and breaking it out between your 3, your 5, your 7, 15-year categories so that you can deduct them much more quickly and recognize they're really not structural components, and our flooring and our cabinets and our window coverings, they're not going to last for 30 or 40 years. So by being able to accelerate those, everything then that has a useful life shorter than 20 years will qualify for bonus depreciation. And so that's here, cost seg essentially reallocates your structural building components into the 5, 7, or 15-year categories. Therefore, they qualify for bonus. And what bonus does, it allows you to take these amounts depending on the year you buy the property. And then, so well, I'll give you an example on the next page. So the bonus in these years was 100%. Anything we drop into these categories, you get to take the full deduction in that tax year. Anything we drop into the 5, 7, 15-year categories, we take 80% for something bought last year, 60% of it, anything bought this year. And then the remaining just trickles over those, the 5 years or 7 years. So this is a huge benefit. Bonus was passed in the Tax Cuts and Jobs Act of 2017 and has been applicable since, which has significantly driven activity in single family homes and short-term rental properties because of the tax benefits. To give you an example of how it calculates, if we have a $2.5 million purchase, I'm assuming land has already been extracted. So our tax basis is $2.5 million. Without cost segregation, this property is going to generate $64,000 in depreciation, just straight line, the normal process. We have had cost segregation for over 40 years. Bonus wasn't in existence prior to 2017. And so before bonus, the depreciation for this asset would be $172,000. It was about 300% of what it is without. So it was still a great number. People always ask me, they're like, oh, we heard cost seg is going away. Cost seg is not going away. It won't ever go away. Bonus is trickling down, although we do expect extension after the election. We're hopeful that we'll get an extension to 100% bonus, but we'll see. Now, utilizing cost segregation and claiming bonus depreciation in this scenario essentially gets you year one depreciation of almost $800,000. If you just imagine you buy a $2.5 million building, in this case, really a $3 million building, which would likely have been a $600,000. If you put 20% down, let's say it's a $600,000 down payment. So $600,000 goes in, you leverage the rest, you buy it December of this. This was a couple of years ago with 100%, but it was closed early December. The taxpayer gets an $800,000 deduction. Depending on the tax bracket and how much you have, again, I gave you the explanations and calculations of what your tax rate is, how much you save. When we deal with California investors or New York in a high tax bracket, we could be in a 50% tax range. We could be 40%. The top federal bracket is 37%. So at a top tax bracket, that would actually save you $300,000 in taxes. This 794. So if that's the case, if you put $600,000 down on a property and essentially you get a $300,000 refund back, you really only had to put $300,000 down and you've got a $3 million property. So, big numbers, but even if you look at the same numbers and you take a zero off of this and say it was a $300,000 house with a $250,000 basis, the depreciation is about $80,000. It's very significant numbers. And again, is a big driver, as I'm guessing you can see, of why we're seeing so much activity in the rental space. So the strategy that we see really is how do we evaluate active participation versus passive activity? One of the big things is looking at the married status. Are there two individuals? Are they filing jointly on their tax return? Do both work and have W-2 incomes? And if so, is one of them interested in retiring or not working and becoming a real estate professional, actively managing their real estate and managing rentals, which could free up a tremendous amount of tax dollars, depends on what your income is and how much you're paying in taxes. But looking at that to see if one of the spouses can meet that requirement is a strategy that we see very often. I mean, again, daily, with many of our physician clients, many of our attorneys, professionals that have high income, and they're really looking at how to structure this. Another one is looking at semi-retirement. We have a number of actually physicians who go into semi-retirement and they work part-time. And then they spend the other part-time managing real estate. And it frees up and creates this active participation rule, which thereby creates all of this access to that depreciation, which offsets your W-2 income and then gets that money back, or essentially prevents you from paying income tax on your W-2 income and from the rental income from those properties. And so that's kind of the synopsis. I hope that makes sense. I think that was a lot. That was a big explanation of how tax and all of that works. But we have a little bit of time. I'm sure you guys have questions. And so we're going to dive into some questions. Oh, my screen just jumped. So we can dive into some questions and go through this. Do you have some that you want to share, Megan, or do you want me to just go through?
Yeah, so we'll start with Elena. So she's asking, is it general real estate related activities and not just on a specific property? I think she's referring back to the real estate professional designation. So is it just, and Elena, please feel free to chime in if you want to kind of get more specific, but I guess, yeah, is it general activities or does it just have to be on that one specific property that maybe you own?
Yes, thank you. And I apologize. I don't know what's happening with my screen, but it's going wild all by itself. I'm doing nothing. I'm like, I'm not touching anything and it's going crazy. So I just stopped sharing.
All good.
Like, wow, something just took over. Okay. So to Elena's question, it is general real estate related activities. You are correct. It does not have to be all on one specific property. Now, the caveat is you can have a short-term rental and then you can have a long-term rental, and the long-term rental activity will not apply for the short-term rental loophole. So you can have one property that's active, but the long-term is still passive. So I will, differentiate the fact that the properties can be viewed as individually standalone. That gets into some complications where you can't actually create grouping rules. You can restructure your LLC. There are some things you can do, but we won't get that deep in. The real estate related activities are related to anything relating to real estate. I have a construction guy who's a contractor, and he owns some rental properties, but he is able to qualify as a real estate professional, even though he works full-time in his construction business, because it is all real estate. Everything he's doing, even though it's not directly managing his rental. So Elena, I hope that helps answer your question.
I mean, does that include even you're driving around looking at properties? I mean, anything like that?
If you're, it can include time evaluating properties, and really looking at, potential rentals and, doing the due diligence, calculating out potential return on investments, all of that stuff. Yes. Yeah.
Okay,
Yeah.
great.
Yeah.
Sarah is asking if you meet active RE or RE status and buy a property and do cost seg that year, but do not meet active status the next year, what happens to the depreciation on that project?
It'll become suspended. So it's applicable the year you are active, but then if you convert back to not being active, it will become a suspended loss. And so then it will not apply again to your W-2. It will carry forward. So a suspended loss essentially is a carry forward loss that will sit there, roll with your tax returns, and just offset any of your other passive income. So rental income, investment income, anything else that is generated. So it can still be used at some point, but just not against your W-2 in that year. You're no longer passive, or you're no longer active.
Okay, great. I know in one of the previous webinars you mentioned, and correct me if I'm misspeaking, cost seg, you can go back. So maybe if you didn't do it, there's like no time limit as far as you going back and applying those rules. Is there a time limit for real estate professional designation? So say maybe you just learned about this, but you've been in that role for the past 2 years and you just didn't realize it. Can you go back and reclaim that?
Yes. Yeah, that's a great point. Yes, the cost segregation allows you to actually go back retroactively and catch up any deductions. And so this is something we see with investors who have been working in W-2, they have been passive. Maybe they've owned the properties for 3 or 4 years. Now they've changed their situation. Someone retired, now they're no longer working. And so now they have become an active participant. Now you can apply the cost segregation, bring it up onto the next tax return, and take that depreciation as active on, in this case, the 2024 tax return. And you don't have to go back and amend anything. We just make a change retroactively.
But as far as the real estate professional designation, that piece, could you go back and say, oh, I didn't know this was I didn't know I could claim this designation a couple of years ago. Can you go back and reclaim that designation for?
Yeah, good question. In order to do that, you would have to actually amend your tax return. And so you would actually have to go back, amend, and recheck that box as a real estate professional. Whereas with the cost seg, you don't have to amend, it goes on the return. So if you wanted to go back and try to get retroactive refunds, there's a possibility of doing that.
Okay, great. And Stuart has a question. If you don't mind just scrolling up in your chat, Heidi. So
yeah.
If you can maybe go into some more detail in regards to depreciation. I think he has a pretty specific question here.
Yeah, I saw it, Stuart. I appreciate it. You're saying, I'll read it because I think this is actually fun. Why don't tax professionals talk about the other side of depreciation? Depreciation ultimately is a scam. So if I spend $100,000 and it has to be depreciated, that means I have to pay the tax on $80,000. I have to wait another 4 years to get all of that tax write-off. But the asset may last 5 years, but the cost is all incurred in the first year. So the only way it makes sense is to get a loan for 5 years, in which case interest is paid in addition to the taxes. It's a good point, Stuart. There are some caveats to that. So if it is a 5-year asset, it can qualify as a standalone. It can qualify for a 179 deduction, which allows you to claim all of it in year 1. That's why they have bonus depreciation as an option to take all of that year 1. But the depreciation on something like real estate and long-term assets is a way to really essentially draw that out over time. You're correct, you could pay all of that, but on the flip side, most, I would say 95% of our clients are not buying their real estate with cash, they're buying their real estate with leverage. So they're putting 20, 30% down, leveraging the rest, and yet still getting depreciation very quickly, typically significantly more depreciation than they're actually putting in cash. So on that flip side, there is a pretty strong benefit for that. You are correct that in the tax code, there are scenarios where depreciation is drawn out at a time where you had to incur the total cost year 1. There is a scenario right now with research and development You have to amortize payroll costs over 5 years. If you're, for companies, let's say, that are building a software platform, they invest $2 million on wages to pay a team to develop a software platform. They pay out $2 million. They can only write off 1/5 of it every year for the next 5 years. They can't deduct full 2 million. It is that, I would argue, Stuart, that's a bit of a scam. That's hurtful. It's very detrimental to taxpayers. So, this is the complexity of the tax code. So I don't think I have any other comments other than, this is the tax we're stuck with. So we do what we can to make it work for us.
There you go. Thank you, Heidi. Cole has a question. So Cole has a consulting practice managing waste recycling services for facility owners and operators. It includes industrial services as well as commercial, such as hotel chains and convenience store chains. Can his consulting work have potential of being classified as an active professional and not passive? Or what would he need to do to be shown to qualify this change in his label, or I guess designation?
Yeah, good question, Cole. It's going to be a little bit difficult on the waste recycling for facilities. I think it'd be a little bit more of a service versus physical work on real estate, because I think you're servicing more of the business than the actual real estate asset, right? So if you were physically working on the building itself, that's a little bit different. If you're an HVAC contractor and you're building HVAC within a building, or you're roofing and you're doing roofing, there's a little bit more leeway with arguing that that's real estate specific. I think it would be a stretch to claim that on your consulting practice.
Okay, thank you. Let's see, let me go up here. Shamar is asking, what about properties you own in another country?
Yeah, so depreciation is still eligible for buildings that you own in another country. There's a different depreciation cycle, and it does not qualify for bonus depreciation. So that's the one downside, is you don't get the big lump sum that we see for US-based properties. It trickles over a few years, so there's still good benefit, but just not quite as dramatic as what we see for US properties.
Thank you. So Scott, what services would you recommend to help us with keeping records so that if we were audited by the IRS, because we are forced on our real estate investing business and short-term rentals, and we don't have time to keep up with meticulously paperwork?
Yeah, Scott, it's a great question. There are no mandated requirements. The IRS has a phrase. They say the onus is on the taxpayer. And what that ultimately means is whatever you file on your tax return, you are signing at the bottom saying, I'm telling you, I've done my homework, and I am in fact filing this according to what I have all the facts to support. So if they look at it, they're going to say, okay, great. Well, you said you have all the facts, show me. So there's nothing more, it's very vague. So what we typically say is keep a log, notebook. But like in a short-term rental case, those platforms in and of themselves have a tremendous amount of data. You're seeing messages, text messages, approvals for rents, when they're leaving, writing reviews, having other people write reviews, responding to comments, calling the cleaners. There are certain things that are just going to be tracked in these platforms anyway, that, especially if it's the short-term rental loophole and you're looking at 100 hours a year, that's not that much time. And I would imagine that activity just in the VRBO is already pulling significantly more time that's gone into it from there. So that's what I would say, is keep a log, keep general notes, keep a calendar, track emails and correspondence in one place. So if nothing else, you can pull it up and say, well, this was my calendar of what I ended up having, who I met with and what I was doing this week. So again, I'm not saying you have to have a detailed computer printout of every minute of every day, but just, track what you can in terms of days and weeks and what you're doing at different times.
That's great. Jared is asking, so he has a property management company that he's 1/3 owner in. What would he need to do to show in order to qualify as a real estate professional?
Yeah, so that certainly helps. Being a property manager, I mean, that is absolutely falls within the parameters of being a real estate, being in the real estate related activity. So if that's your full-time job, and then you have other rental and real estate activity, that will typically qualify you as a real estate professional. So typically your job itself, in addition to your rental activity, is enough to defend that position.
Great.
And keep in mind, I want to make one other comment before out of time, that this real estate professional designation, there's no certificate, there's no formal qualification, there's no application, it's literally a box you check on the tax return. That's all it is. It is a box you check. Are you a real estate professional? Click yes. That's it. That's all. But when you check that box, that ultimately is saying, I understand what this means, and I have done all the things. I understand the facts and the rules. That's why your CPA tends to push back a little bit. Because if you don't have the data and you haven't provided it to them, they're not checking that box. Mm-hmm. So you have to communicate with them what you're doing, why you have the activity, and that box needs to be checked. But that's ultimately, I mean, you track the time, and that's essentially how it functions.
Yeah. So Jared, going back, he's one with the property management company. He's 1/3 owner. If it's not his full-time job, is that a problem?
You definitely, you have to, again, the real estate activity has to be more than 50% of your time or more than 750 hours for that, unless you're short-term rental, that's different. So it just depends on how much time you're spending. You have to look at it and say, is it more than half your time?
Okay, and I know we're almost up on time here. I will drop in the chat. So if you would like to get connected with Heidi just to learn more about active versus passive income, or just to see, how these rules can apply to you, I'll drop the link in the chat to get a call scheduled with your wealth architecture coach. And then Heidi, one quick question for me. Do you foresee the short-term rental loop changing at any point? I know that they created it not expecting Airbnb. So do you think that will change?
We don't believe so. We haven't seen any movement or anyone really even bringing it up to make that change. So at this point, we don't expect that will change. But tax law, you never know.
Yeah, sure. Okay, well, thank you so much. I think we've got all of our questions answered. And again, everybody, I'll get this replay uploaded on the dashboard as well. But Heidi, thank you so much for being here. We always love having you. And yeah, thank you. We truly appreciate your time.
Awesome. Thank you so much. Good to see you guys again. Thanks for joining.
Thank you. Bye-bye.
Bye-bye.